Good morning and a very warm welcome indeed to today's Movers and Shakers virtual event. My name's Natasha Salter and I'm Managing Director for Movers and Shakers. We've got over 600 people registered for today's event, which is excellent. And we've got quite a few newcomers and a number of people from overseas. So thank you to you all for joining us. For those of you who are perhaps not familiar with Movers and Shakers, we're the UK's premier networking forum. We actually celebrate our 25th anniversary this year, and we're really proud of the years that we've spent bringing together leaders in both the private and the public sectors, enabling them to do business and to win work, and of course, putting on first-class speaker events. We're really enjoying our virtual events programme at the moment. We hope you're enjoying it too. If you've missed any of our virtual events, please do go onto our YouTube channel. The events are uploaded. Do watch them, do enjoy, and please do subscribe. So this morning, we have one of our views from the top sessions, which are interviews with chief executives or leaders from across the industry. This morning, we welcome Bill Hughes, who is, of course, Head of Real Assets for Legal and General Investment Management. He's going to be interviewed by Rebecca Worthington, who is now CFO of IQ Student Accommodation. Thank you both for joining us today. The topic today is UK real estate investment, the challenges, the opportunities, the priorities. And I know it's going to be a wide-ranging discussion. We're obviously really interested in the effects of COVID-19 on L&G and on their investment strategy. And also interested to find out from Bill his views for short and long term on the investment landscape and the changes that will happen following COVID-19. Are we going to see a rise in investment in alternative assets? Will ESG stay top of the agenda, or are people going to be returning to looking at just pure commercial returns? So really interesting to find out more. I know that Becky will ask these questions and many more. You do at home have the ability to ask questions. There's a Q&A tab on your screen. Do submit questions. And I know that Becky and Bill will try to include as many as they can in today's discussion. It's a 30-minute session, so indeed they'll do their best. And I'm going to leave you now with Becky and with Bill. Thank you both, thank you all, and enjoy.
Thank you very much, Lee, and good morning, everybody. So, with the impact of COVID-19 reverberating around the property industry, we're all trying to get a handle on what it means at the moment. So to have one of the doyens of the property industry here with us today, I think is going to be quite insightful. I've heard Bill being described as everything from earnest to intellectual, and so I'm sure he will share his wisdom with us today. Right, so to kick off, Bill, given the scale and diversity of LGIM's real asset business, you're really well positioned to see the impact across the whole market. So perhaps you could talk a little bit about what you're actually seeing in the market at the moment.
Thanks, Becky. Yeah, thanks for that kind introduction. Yes, we have got a significant portfolio, principally within the UK, although we have got some investments around other geographies. There's no doubt there's some unexpected disruption in all asset classes, and the extent to which the market's been disrupted has been across a wide spectrum. In the real estate equity world, I'll tell you the sector that's experienced most change is leisure and hospitality, because all of those assets have been closed, so that those assets are not capable of delivering any sort of trading revenue. But at the other end of the spectrum, build to rent, for example, whilst it hasn't been operating exactly as expected, it's been really successful at delivering expected income and adapting to COVID. So really an array of outcomes across different aspects of the built environment.
And do you see the changes that you're seeing across these various sectors? Do you see them as temporary changes? So will build to rent resume within the next couple of years or in the next 12 months? Or do you see them as far more permanent changes?
I think that is a question that everyone is thinking about, and I can't pretend to have perfect foresight on that subject. I think at the moment, my view would be we have got a period of time, and it's going to be between 1 and 2 years, where there are some genuine different circumstances, and some time will need to pass before any sort of return to normal circumstances. So you've got a 1 or 2 year period within which there will feel like some unusual and exceptional circumstances. Beyond that, I think I'm broadly of the view. Beyond that, the magnitude of change, long-term change, will be less important than long-term structural changes that we would see in the economy, in society, and in the built environment anyway. So that in my mind, I've got it down as being two different phases. I'm sure we can debate about the extent to which that's either true or not, and also where greatest change may happen. But there's no doubt, in many ways, the COVID environment has accelerated existing trends in many cases, but also brought in some new challenges, which will, I think, change behaviours for a while to come.
So let me dive into the retail sector then, because clearly that's been a sector that's been very hard hit and was undergoing structural changes anyway. Now, retailers are asking for rental structures on an ongoing basis to be changed to a way that works better for their business model. So talks of moving from base rents to turnover rents. Is that going to happen? What's that going to mean for investors?
Yeah, Becky, the way I see that subject is that there have been a lot of owners of real estate who've been trying to hang on to the past, trying to hang on to the long lease, trying to hang on to the just the lease structure, fully repairing and insuring, trying to de-risk itself from what's really happening in the buildings that are owned. And in retail, because of the pace of change, I see no alternative but for owners of real estate and the retailers themselves to participate together in sharing risk and return. And if that works well, then both parties stand to benefit. And if there's a broken relationship where the owner and the occupier are not working hand in glove sufficiently, then that doesn't really help. So, long-winded way of saying, I do think that the future for owners of retail space is very different, and is going to be much more about some sort of participation in business risk. You call it turnover rents. That's one way of dealing with it, and much less about relatively arbitrary rental payments over very long periods of time that in many cases can put a retailer in trouble.
And then if we move on to offices, what about the future of offices? I think this is one thing which people are struggling to get a handle on, whether it's temporary, whether it's permanent. Are offices genuinely going to look different in the future? Is home working going to carry on? What are your thoughts on that?
So let me put it in context a bit. I would say that when I started in this industry right at the end of the 1980s, there was a lot of work being done.
Surely not that long ago.
Yes, that's very kind. Thank you. There's lots of research that was being done at the end of the 1980s, early 1990s about how the remote working practice was going to become massively important because the technology existed. But the reason for saying that is the technology has really been there to an extent for 30 odd years. This is different to the extent that most people in office environments have been forced into actually working from home. And I would be a case in point of someone who's not spent much time doing that in recent years. It's not been where I've worked from. And so I've had some personal challenges around that and getting the technology to work and the equipment and the working patterns and so on. But to cut a long story short, that this has been on the cards for many years. When you force businesses and people to actually do it rather than theorize about it, they learn stuff. And what they learn is that lots of things can be done remotely, and things that you can do in the office don't really need to be done in the office. you also learn that there's deficiencies of working remotely. Obviously human interaction, associated things, but other elements of the working day that can be less productive when you're remote. So what I would say is the demise of office accommodation, in my view, is significantly overstated, because I think that lots of businesses will continue to have a material amount of their employees in an office environment, and I think that the interesting conundrum is the extent to which density of office occupation changes for good, which I suspect is going to happen. So I think lower density occupation happens. Some people will work remotely, but by no means all. And that's a way of me saying, I think the permanent changes we might have thought that would happen to the office sector are actually not really going to hit in the way that you might have thought. You know, the factors that affect office demand are about the number of office employees there are, the extent to which they need to be in the office. And I would say the aggregate position is actually not that changed, especially when you end up with lower density of occupation.
And when it comes to offices, one of the things that I've been trying to get my head around is, how do serviced offices end up coming out of this? Because if I reflect back to the GFC, whilst going into it, serviced offices said they would be stronger. At the time, I think unsurprisingly, they struggled through that period because it was the non-fixed cost. But as we are genuinely changing some of the ways we think about working, do you think that paints a different picture for serviced offices in the future?
Yeah, I don't think my view of service offices has particularly changed. So I think service offices was always a relatively fragile model. If it's based on, you know, beer and ping pong, I think that has limited long-term appeal. What I do think is here to stay is some sort of more flexible office offer, which is about, it may be about an element of service, but it's more importantly about shorter leases and flexibility around that. And I think that's going to be an important part of the economy forever. And if you look at the next few years, I think there'll be some very interesting decisions for occupiers of offices to make about how long do they want to sign leases for, in what locations, and the waxing and waning of office demand will mean that there needs to be an element of flexible office space in the system, provided better than 10 years ago, for sure. I think the serviced office organisations have definitely raised the bar, and I think that's great. But if you look at our office portfolio, we are overtly looking at providing good quality, medium-long lease assets, and we're also providing flexibility in office locations for those that want it. And I think we can flex what we do in terms of the provision of offer to reflect what demand is going to be. But at the moment, I think flexible offices, yes. Serviced offices as a model has always been fragile.
So you've raised what your business is looking at. The changes that we're seeing now, do you think they will have an impact on either the way you structurally hold assets or your asset allocation between sectors?
I think this goes back to something I said a few minutes ago. I think a lot of what's going on supposedly under the banner of COVID is actually an acceleration of existing trends. So we, for several years, have been underweight in retail, and that's where I want to be. For several years, we've been developing the flexible office offer, and again, that's where I'd want to be. I think one of the trends that has emerged through e-tailing, nothing really to do with COVID initially, is logistics and delivery of goods to people's homes. Again, there's a trend that was happening already. So honestly, Becky, the answer to your question is, I think we allocated and we went overweight and underweight in the right parts of the market in advance of COVID for trends that were already pretty visible. And COVID is more than anything in that sense an accelerator. But I think we've got ourselves on the right side of the argument there.
The other thing that that you've done quite a bit of in the past is public-private partnerships. Do you think that's a trend set to continue within your business?
Yeah, we have done a lot of that, and the reason we've done that is for long-term regeneration. I think the most effective way of approaching that is for public sector and private sector to work together. It seems inevitable that for several years to come, let's talk probably about the next decade, there's going to be a greater level of government indebtedness than was the case before. So the requirement for private capital to participate will be greater, and the likelihood of engagement by public sector officials, be they political or professional, I would say is likely to increase. So yeah, again, it's another one. L&G have definitely made inroads there and made a virtue out of public-private partnerships in a range of cities around the UK, and I would expect that to accelerate. It will become, if anything, a bigger part of what we do.
Another trend that L&G have been focused on over a number of years now is ESG. How do you think, I suppose, how will L&G see it through this period? But probably more interestingly, do you think other companies who have been starting to be more proactive in ESG are going to now push this along much further down the agenda, because they're focused on anything from survival to collecting rents into understanding where their business model is going, and therefore this isn't either a priority for their time or possibly even for their wallet?
Yeah, it's a good question. I can definitely talk about what L&G is going to do, but your question is more interestingly about what others will do. You're right. There will inevitably be participants in the built environment who are going to be about survival, and will deprioritize thinking about ESG in a way that is unfortunate but probably inevitable. For the likes of L&G and other organisations that are substantial long-term investors in the built environment, if anything, I'd say our commitment to ESG against the background of moving to net zero is redoubled. I think of the next decade as being a time where we've got a lot of work to do in terms of investing in the UK economy, and we need to make sure that that's done in a sensitised way that is moving towards net zero, that is green in all sorts of ways, which takes care about embodied energy as well as energy in use. So that's what we'll do. It feels to me that the organisations that have been talking about ESG for some time will stick with it, and it's maybe the Johnny-come-latelys who may be thinking more about survival that will deprioritise it. But I would like to think that through the passage of time over the next few years, everyone gets on board with that subject. What we do need from government, though, in that area is some sensible thinking about carrots and sticks, incentivisation, and actually penalties to encourage the right behaviour. Because if you leave it to the market here, I'm not confident that everything that needs to happen will happen.
Well, I'm sure from a people on the ground point of view, a lot of people have appreciated the cleaner air that came about through the lockdown, if there was one small glimmer of interest and excitement about it. So it seems at that level, climate change is something high on individuals' agendas, and therefore I guess it's about pressure to put that on companies' agendas, isn't it?
Yeah, no, I would agree with that. And if you think about one of the facets which affects me is, what is our client base saying? What are our pensioners saying? What are the international clients we have saying about that subject? And I think you're right, Becky. I think people, that's one of the positive effects of COVID, that people can see what happens when the pollutants that we're all used to, particularly cars and to some extent industry as well, what happens is the air's cleaner, and most of us can. I live in London. I mean, you can feel it. You can definitely feel it. I gather in Kathmandu you can see Everest, which is 126 kilometers away. That's never happened in our lifetime. So that's pretty amazing. And so I do hope that people grab hold of that thought. You know, clean water is another one. Seeing all sorts of things in society that people won't have experienced, and I think we should remember that as we go forward.
Just moving to a slightly different topic, and valuations. So as of the 31st of March, valuers were including material uncertainty clauses across all their valuations. A few are now being pulled back. How do you see what impact that has in the market?
Yeah, so first of all, I'd say hats off to the valuers who are doing a tough job. They've got very little transactional evidence, and much of the evidence that you could look to is based on behaviours and decisions and transactions that were closed or at least agreed before COVID came along. So tough old job for valuers. I absolutely understand why they would need to have a material uncertainty clause there. I think the interesting area is how do they remove material uncertainty clauses, both in terms of what evidence do they need to see, in what order do they do that, because some of that's, as you know, happening asset by asset, some of it's more sector by sector. And I could imagine getting to a place maybe late summer where the majority, if not all, of the MUCs have been removed. Maybe not in all sectors, but that feels to me like a realistic possibility. And all that means is that the true market value of assets in these uncertain times is difficult to assess. That's why transactional volumes are low. That's why the open-ended funds world has suspended almost unilaterally. And so, you know, all valuers will be looking forward to a time where they can remove those clauses, get back to a semblance of normality, which is when transactions will happen, the market starts to clear. As I say, I would expect that to happen late summer, but not sooner.
So picking up on a couple of questions from the audience. You're particularly well positioned to answer this one, Bill. So question from Barry Shaw about the demise potentially of FRI leases and a move towards, and as you said, a more risk sharing basis. Now, one of the concerns around this is going to be how debt providers will think about lending on these different types of rental agreements. So obviously you've got a debt book as well. What do you think? How do you think lenders will respond to those changes?
Yeah, let me talk about the build to rent sector as an example. Okay, so you go back 5 years. In the UK, valuers didn't know how to value lots of short leases, and it was a difficult space for them to go to. And aside from one American lender, there were no lenders who would lend to that space for the same sort of reason. And philosophically, what needs to happen, both with lenders and valuers, is to get across the bridge of saying what truly is security of income. Because I think it's a little bit fictitious, and COVID has really brought this to light, by the way. It's a little bit fictitious to think that just because there's a long lease in place means that income is secure. In the retail space, we all know that effectively as an owner of real estate, you're exposed to operational outcome anyway, because your retailers may go bust, may go under, may execute a CVA. And so I think there's some fiction in there about how people think about security of income. And I'd like to think that we move to a world where there's a reassessment of what security of income really is. And it's closer to what happens in other markets around the world, actually, where leases are shorter, in some cases where there's operational income as well as contractual lease income, and forming an assessment of its security is what valuers and banks need to do. That's the future. There's no point trying to hang on to a long-term institutional lease because that's what people will lend against if those things A, don't exist, or B, may just go pop because the rents are too high and someone's going to walk away from the lease or go under. So I'm not saying it's easy, but I see no alternative but to move forward to more operational exposure, shorter leases, and for the industry to grow up and get used to that.
And turning to another question about are things going to have to change in the industry? So thank you to Rupert Young for this. Given Travelodge as an example, do you feel that the CVA legislation needs reviewing?
Yes, I think the CVA legislation is painfully exposing owners of real estate to unfairness of treatment, and the abuse of CVAs has been around for some time, and I've seen insufficient focus on that from UK government. If you talk to international investors, they're pretty surprised that we have that sort of regime in place where landlords are really the last to be considered, where our voting rights in the list of participants affected by a CVA, our voting rights are massively less important than they should be, and that does need addressing. Yeah, I think that's again not a COVID issue particularly, but absolutely absolutely needs addressing as a matter of urgency. Yeah, I would agree.
Thanks. And one more audience question before I wrap up with my final question. So we've been asked, Bill, could you talk a little bit about CALA and about what this means at the moment for residential and build companies?
Yeah, so we're involved in house building in a whole range of places. CALA is one of the LNG aspects that we do build to rent. We fund social housing, later living. If the question is about the market, I would say the long-term mismatch between supply and demand in all of these parts of the housing market means that prices are pretty well prices. I think the market's underwritten by supply and demand imbalance, so it'll come back. It'll be there reasonably positive after clearly a few months of disruption. If the question is about construction and building, then our experience is getting people back on site has been difficult, but is happening more and more. Most of the buildings we're involved with are up to something like 50% capacity, if I had to pick a number. And house builders are definitely able to function at a level whilst observing social distancing. Obviously, as social distancing is lifted, that becomes easier, and as normal circumstances resume, you'd expect most aspects of the residential sector, be it rental or ownership, to resume some sort of normality. Within the sector, though, of course, there's always going to be winners and losers, and I think, reading the demand and being in the right parts of the market with the right specification. By the way, ESG being, I think, a really important part of that, is going to be critical.
Thanks. So lockdown has been a period, I guess, of both business and personal challenge for everybody. So it would be great to finish off just with a quick insight. And has it been particularly challenging? How have you stayed sane? And are there any changes that you've experienced that you would now make permanent as a result of it?
I think it's been difficult for everybody, and I spend a lot of time talking to people in my team, and there's this whole spectrum of reactions to what is undoubtedly for many an uncomfortable and unfamiliar experience. For me, I would say I've learnt or maybe got into the habit more of getting out of bed and exercising first thing, getting up a bit earlier to start the day, because that punctuates the difference between being there in pajamas and the beginning of the working day for me. And similarly, at the end of the day, I tend to wind down with a soft drink or a gin or something along those lines to punctuate the end of the working day. And what I'm saying there is, what I miss is the mental switch of moving from a work environment to a home environment and back again, and finding ways of dealing with that. I think has been, for me, actually, I've got there, but it took a while. The best thing about working from home for me is I live next to an opera singer who's clearly not traveling the world to sing opera, but what he does do at lunchtime is practice right next to my kitchen. So I get my own performance of opera at lunchtime, and that's brilliant. So I'm going to see whether or not working from home a couple of days a week is going to be a permanent fixture for me. And I definitely think that I've learned a lot about how important it is for certain aspects of the working experience to be together. Things like strategic discussions amongst lots of people. I think you have to be together. Things like rushing to get a really important report out there that involves 4 or 5 people contributing in a really tight time frame. You need people to be together, because then they can work in parallel and piece it all together. So I think there's limitations of being in a work from home environment, but that said, it is possible to stay afloat on many things as well. So I'm going to become a bit of a hybrid worker, I'd say, going forward. I'll be listening to opera at lunchtime once or twice a week, I hope.
Well, it's a shame we didn't schedule this call for lunchtime. Then we could have all have benefited in the background.
We could have, yeah.
So thank you very much, Bill. I think you definitely managed the insightful.
Hello again. Thanks, Becky. Thanks, Bill. That was absolutely fascinating. And thanks for your honesty at the end there, Bill, particularly. That was really, really interesting. And I think, people are absolutely considering what we do going forward in terms of working from home and going back to the office, and kind of the benefits of both. That's really interesting. And interested in the ESG, for a couple of people were asking, it's environmental, social governance. And I think, I'm glad that Legal & General is still keeping that top of the agenda, and I really hope that it does stay so for many other firms. And interesting that you guys are still thinking that we need more private-public collaboration, and I think that will happen going forward. And again, in all these discussions, people are talking about the acceleration of current or existing trends, and it's fascinating to see what is happening and what will happen going forward. So thank you both, and to remind everybody that this will be uploaded to YouTube later today. I'm sure people will want to watch it again. There's lots of information in there about all the markets, and it's really, really interesting. So thank you both, and just to remind our viewers that our next virtual event is next Tuesday the 9th, and it will be on rebooting mixed-use development in the Southwest. We've got a great lineup. Do register on our website and do watch that next Tuesday. So thank you so much to everyone for viewing today. Thank you to our speakers. Keep safe from our family to yours. Thank you.